Hi, welcome to Grand Insights. I'm your host, John Feligno, founder of Grand Life Financial. Today, I'd like to cover the options that you should consider with your prior employer's retirement plan. And examples of that would be a 401k or a 403b plan. Depending upon your situation, you could have up to five available options. So the first one is the simplest, requires the least amount of work, and that's maintaining your previous employer's plan. If you have a substantial amount saved, above $5,000, and you like the investment choices available to you, then leaving it with your prior employer might be the best way to do it. This is particularly beneficial if you're comfortable directing your own investments. And if you have left your job and you're at age 55 and older, you can take penalty-free withdrawals. Fees will generally be lower than managed accounts as well. And I'll talk about that a little bit. You could also option available could be rolling it over to your new employer's plan. Now that's if they're permitted to do that. Then this would allow you to consolidate your retirement accounts. And rollovers are done generally as what's called a direct transfer, which is from one custodian to another, or an indirect rollover. And that's when the check is mailed to you. If the funds are sent to you, then you just want to make sure you redeposit those monies within 60 days after you receive that in order to avoid tax penalties. This could allow you to take advantage of loan and hardship withdrawals. You may be able to defer what are called required minimum distributions if you're still working after age 72. And again, generally going to pay a lower fee than a managed account. The third option would be if, say, you're not joining a new employer or that new employer doesn't offer a retirement plan, then you could do a rollover to a self-managed individual retirement account. And that just means that you're really controlling the investment choices. But generally, an IRA is going to provide a broader range of choices than an employer plan. And if you're under age 59 and a half, you can withdraw money penalty free for a qualifying first time home purchase or for higher education expenses. Again, IRAs generally are going to have lower fees than managed accounts. And if you have employer stock in the 401k, it might make sense to take advantage of a net unrealized appreciation tax strategy, which is just more favorable tax treatment. If you're close to retirement and the stock has significant capital gains, appreciated a lot since when you received it, then you would not want to consider rolling that over. The other way to do the IRA is to have it managed by a financial professional. And in this case, that person would help you choose investments and allocations that are really tailored to meet your individual needs based on your goals, your risk tolerance, and your time horizon. It'll reduce overlap if you have multiple investment accounts. And these will incur higher fees, but that's again because you have a professional managing that for you. The last one is probably the least optimal, and that would be taking a cash distribution. Generally, if you do that before age 59 and a half, you're going to be taxed as ordinary income because you did not pay taxes on the money when it was contributed to the 401k or 403b, and it could be subject to a 10% early withdrawal penalty. You're going to forego tax deferred growth, which you've been enjoying the time that you've invested that money. And probably most importantly, it may impact you not having enough saved for retirement. If you have any questions, please email me or call. And if you have any ideas or questions for future topics, please send those along. Thanks very much for joining.